Hi, I'm Rick. Our company TCF specialises in accessing the research and development tax incentive. Now, the big issues that we have when talking to clients is that, firstly, the government aren't very good at telling people what the R&D tax incentive is and who's eligible, and and when they do write it up, when they do advertise, they put it in such arcane bureaucraties, jargon that people don't understand it. And so, they talk about you've got to have a hypothesis and the scientific method, which basically translates into English, this is what we want to try and achieve. We're not sure exactly how we're going to achieve it. We're going to have to do some tests to see if we do it. If so, we'll sell it. We just translate that into the scientific method. That's all it means. And so that's one of the big barriers that a lot of people think they're not eligible. A lot of people just think that they're, think of R&D as people in labs in white coats. And I've claimed for a husband and wife in a garage, and all the way up to multinationals.
My name is Mal Watkinson. I'm the Associate Director for EFIC here in Queensland. So EFIC is a specialist financier that delivers simple but creative solutions to Australian businesses to assist them to grow internationally, win business and achieve export success. So the purpose is to support the growth of Australian businesses offshore. It does have to have an offshore flavour for us to provide assistance under our mandate. So the mandate does come from the Australian government. We are 100% owned by the Australian government, which is quite important in terms of the support that we provide Australian exporters. And it's really off the back of the Australian government's AAA rating. You can look to help businesses with turnover up to 150 mil. Once it goes past 150 mil, my colleagues at our Structured Trade and Project Finance department will take that opportunity. The minimum finance requirement is $100,000. Historically, again, that's been more like $500,000 in a bid to help more SMEs. We support growing businesses, so the clients that we talk to are growing very quickly and quite often outstrip the tangible security that the bank can traditionally rely on. The financier is unable to provide assistance is a prime requirement under our mandate. So first question we generally ask the client is, have they talked to their current financier in relation to what they're trying to do? If they haven't, we point them in the banker's direction. If they have, that's when we can proceed with a transaction. We do operate in all industries. We have seen a spike in terms of agribusiness inquiries, given weakening Aussie dollar and continued strong demand from offshore markets in terms of agricultural products. And we will deal with most geographies. The only countries that we won't traditionally deal with are countries with sanctions imposed by the various governments.
So I was with PricewaterhouseCoopers for almost 20 years, and I guess, like a lot of people, got fairly frustrated with the industry in terms of the model was basically to come in 9 months after year end and bayonet the wounded long after the war was over. And so there's a small group of us who've gotten together and gone out and basically providing services to clients around outsourced CFO services. So basically bringing high-end and basically highly experienced CFO services. So I've been involved in taking companies through the listing process, through I've got a number of clients who are in the BRW Fast 100, including a couple of current top 10 players. One of those, for example, started off with $100,000 in capital 6 years ago, and he's currently got an offer on the table for just over $40 million to buy him out. And that was basically somebody who bought a twist on an existing market, an existing industry, and has had some phenomenal market success. The opportunity for us to basically take those services out of Big Four and take them to clients where we're involved in the business hands-on, daily, weekly, monthly. There's very few clients where we're not in front of them on at least a monthly basis. And we've developed some tool sets around things like managing cash flow, how to put a finance application to a bank. We've got a lot of experience. A lot of business owners actually don't sell their own businesses very well, and can actually be their own worst enemy when presenting to a bank, because they tend to be a little bit too honest And what I mean by too honest is they don't present the things the way banks like to see them, and they don't present risk mitigation. So we get involved in starting with the basics. Cash flow management. What are your debtors and creditors policies? How are you negotiating with your suppliers? Are you marrying up your debt together with the cash flow and the assets of the business? Have you got asset protection in place? Have you documented and protected your IP? Are you leveraging the sort of grants that are out there? A lot of people don't know they exist, or get very poor advice, for example, and structure their business through a trust and can't get access to the R&D concessions. It's probably the most common I come across. Well, we've actually developed a tool then to get that out of a trust without triggering a whole lot of tax liability, but still get access to the R&D concessions through what we call rights to commercialise. And we've got all the standard agreements in place. So we've developed a whole series of toolkits basically based off our knowledge at the top end of town and bring them back into the SME space. And we're not afraid to get hands-on.
Basically, our business is all about cash flow. That's the only thing we do. And being a Scandinavian company, our approach is to keep things very simple. The reason why cash flow is so important, Jason's touched on it a bit, but basically 90% of all businesses that fail is because of cash flow. One way or another, they fail because they just didn't get the cash flow right. To put that in perspective, that's how many businesses that went into insolvency last year. That's just businesses that's actually owing somebody money. It's not businesses that closed down amicably and just quietly went out of business. These are companies that somebody's actually trying to get some money back from. So when you look at how many businesses that fail every year that were actually operating at some stage, and at some stage probably did pretty well, it is amazing that cash flow is still such a big problem. And to be honest, as a Scandinavian, especially Australian businesses, seem to be about 10 years behind their European counterparts in understanding the need to focus on that part of the business. Most businesses really good at selling, probably quite good at manufacturing. Whatever service you put together, you are probably focusing on the cost of it, the cost of operating your business, but actually getting paid for what you do seems to be not a big focus for most businesses. A lot of businesses feel like if they send out an invoice, that should be paid. They shouldn't actually do anything else. The process kind of finished there. Once the invoice is out, that's a done deal. The way we look at it is the third part of the business, which is actually getting paid, should really take as much focus as selling as manufacturing. Because if you don't get paid, there's no point in actually putting the effort into getting it sold and manufactured in the first place. So an example they always use in our business, which is a very simple example, but I'll use it anyway, is if you produce a chair. If you produce a chair for, say, $20, that's what it costs you. You sell it for $50, but you have a 30-day payment term. That means you produce one chair, you wait 30 days, then when you get paid $50, you can now produce 2 chairs because it cost you $20. Well, if you can cut that time down from the 30 days to a shorter period, that just means that you can quicker get into actually producing more chairs. Now, the problem is that in Australia, we're not even talking 30 days for invoices. The average time to get paid is actually 52 days for Australian businesses.
So for SMEs, that number is actually 66 at the present time.
So that means when most businesses do their cash flow projections and they do it based on their payment terms, that never really works out, because if you're basing your numbers on you getting paid in 30 days, but the reality is you're getting paid in 50, 60, 70 days, well, at some stage you're going to run out of money. The good thing about this is that it's really easy to fix. And it's especially easy to fix because so many businesses are, to be honest, really bad at it. And if you have kids, you've probably seen these statements before because they're actually from Super Nanny. And it works as well for your clients as it does for little kids. you need to set expectations. Most of us don't like to talk to our new clients about payment terms, penalties, all that kind of things, but be upfront, let them know what you expect, so there's no surprises. The other thing is be consistent. Most companies tend to chase up on the money based on the current financial situation. So if you this month are doing pretty well, you probably tend to not follow up on the money so much. Whereas if next month you actually need the money, you'll be on the phone asking for the payment. Now from your client point of view, that makes it very inconsistent. They don't know whether they actually need to pay you on time or whether they can pay you after 45 days because last month that was okay. So you really need to be very consistent in the way you do that part of your business. And the last one, which is one of the really big ones for us, is follow through. You really need to look at, you basically need to get paid. That's really how simple it is. If you have a payment term, you need to make sure that if companies are not paying you, you take some kind of action. And it has to be the same action every time.
A long time ago in a previous life, I had a business with a couple of thousand customers, and factoring was fairly new in those days, and it was sort of frowned on. I mean, from a client end, people would say, oh, Blogs and Co are factoring, they must be in trouble.
Yep.
Has that reputation changed? Is it, I mean, it was valid then. Has that reputation changed? Do people perceive people who are getting their invoices factored as being businesses that are in strife? Or
I think the answer is it depends. It still very much has the reputation, and there's still quite a few factoring providers that provide the kind of services that we don't really want to see in the business, and that is services for companies that really shouldn't be used factoring because they just get into a worse position. Factoring should only be used when you can make more money out of using factoring than by not using it. So it's really good for growth companies, not so good for companies that are in long-term trouble. Short-term cash flow issues, completely fine, really good tool for that. But if you fundamentally have issues in your business, factoring doesn't work. It just gets you into more trouble. And the problem is a lot of factoring companies don't really see it as their role to educate their clients about that. And that's why there's been a bad reputation.
Factoring absolutely has a place. One thing I will sort of warn people, a lot of people don't realise, and they can get themselves into trouble with the bank, is quite often when the bank puts a security over your business, they put a security over all the assets, and that includes your debtors, if you've got a bank loan. To be able to factor, you've got to get a release of those debtors from the security. The banks, if you just walk in and say, I want to release it, they're very reluctant to do it. You've actually got to put a business case to them and almost give them the first option of providing the finance, knowing that they can't. And I've not had a lot of success with the banks' debtor factoring products for the reasons you've touched on, but you do need to get that security released.
It really comes down to the purpose of the original loan. So if it was property, the banks could potentially release those debtors.
Correct.
And if they're providing working capital assistance, they'd be reluctant to let go of those debtors.
I've had success where it's been for where they've provided a long-term business loan, for example, and it's been fundamentally to purchase the business, and there's a goodwill component and so on, where they have been willing to release the debtors. But it's ultimately to show them that what you're doing is freeing up working capital for growth. You're not doing it to plug short-term cash flow holes, i.e. servicing the original bank debt, where at some point it's all going to come wildly unstuck. They're going to want to see that ultimately you're growing the pie, growing the cash flow, but they're not going to run into a debt serviceability problem 6 or 12 months down the track.
Dealing with the banks in terms of, or the banks that still provide invoice finance type products, it's actually their product of choice because it is, in a lot of cases, the most appropriate structure for a finance arrangement. You're providing assistance on a prepayment at a pre-agreed percentage basis, and effectively that's a revolving type facility. So from a bank's point of view, they hate hardcore overdraft debts. And if it's not fluctuating between debit and credit, they do get upset.
It's about matching the debt with the corresponding asset and the corresponding cash flow. And what banks like about it is it makes people invoice on time. A lot of businesses are very lazy on their invoicing cycle. Property development goes in cycles with the banks. They either love it or hate it.
But before you go on, don't get confused, because at this point in time, it's a rural property earning money. Okay, so the actual thing I'm trying to do to refinance a rural property, the next stage is to take it to a development. So there's two separate
Yeah, absolutely. And the I'll probably start with the development part first, because there is a lot of money around for development at the moment.
But you need to have a development approval first.
And to be honest, you also need to have a development background.
Sorry?
You need to have a background in development.
Well, it depends on what sort of development. I've been developing all my life, but not in that area.
Yeah, and
Okay.
the banks got burnt very badly during the GFC by developers who had very little experience, were very highly leveraged, and they owned a lot of property, particularly here in southeast Queensland. And so as a result, as we come around through this time, and I work with a number of developers, and I've done some capital raisings in the last 3 or 4 months where they've been fully subscribed within 24 hours. There is money both with the banks and coming out of private super and from overseas, very, very keen on the property development space. But they're looking for the development approvals, they're looking for very clear plans and timeframes, and they're looking for a track record of delivery. There is mezzanine funding. Be careful with the mezzanine funding. I saw a contract recently where a lot of people sign contracts and don't read them. This was 33% interest for 3 months, and after 3 months it defaulted to 66% interest. And I caught it on the way out the door, where I just happened to be sitting in the client's office, and they said, "I'm just about to sign this up, did you want to look at it first?" This same person had signed up a contract where it had $20,000 per day liquidated damages, and again, hadn't read it. So there's mezzanine finance out there. I'm seeing some schemes put together by lawyers and accountants where, again, you've got to really do your homework, but where they're offering, you come in for 12 months, get it through a certain stage of development, you get your return of funds, and anywhere from a sort of 25 to 30% return on that equity, a second-ranked mortgagee, where, again, depending on the quality of the investment and the sort of numbers they're looking to do, are attractive. Probably some of the best money we're seeing is actually equity coming in from overseas, where they're saying we'll take a 30% stake, and there's quite a lot of money coming out of China, particularly for coastal and, to be honest, tourist assets. We've just done a sale of a resort up in Noosa, where a year ago nobody was interested. It was done off market and inundated with interest.
Your best bet might be to put together a board of quite rather high profile people who really deeply care about what you're dealing with. People that have a commercial background, may I add, not people that are, just coming because they love it or they're social workers or whatever not, but people that have a strong either executive or business owner background, but who really think something should be done about this. You put such a board together, and because you get a board full of, and it doesn't have to be big, it would be 3 or 4 people, but they all come with a commercial mindset. What unfortunately I see in a lot of not-for-profits or NGOs or whatever you want to call it, is that it comes from a handout kind of perspective.
Yeah.
And we are in an economy right now where getting a handout from anyone to anyone is getting more and more hard.
That's correct.
So let's
And
face
it's
it.
not sustainable long term.
It's not sustainable. It's a model that, quite frankly, was broken back in the 80s, but we're only, this country, only beginning to realize, it's kind of broken us probably 30 years ago now. What happens, right? So the reality is that you can put together a strong commercial, or like a board of strong commercial mind who says, hang on, let's just build a revenue model around this. How much do you need? And you just work backwards. Okay, so you want whatever it is, $100,000 a month or whatever your budgets are, and you start realizing, what would it take to put that together? And it's typically not your traditional fundraise drives. It is typically, okay, you go to a bunch of corporates, so who else do I know? Who do I play golf with or whatever? And oh yeah, he'd be interested in pitching in. Maybe you start only by getting some small ones, 10k there or 20k there, and suddenly someone puts their hand up and says, we'll give you 100k. Yeah. Well, okay, no, we'll get them somewhere. And suddenly before you know it, you have it funded.
There's a couple of credibility pieces before you go and recruit that board. One is to become a deductible gift recipient.
Sorry?
To become a deductible gift recipient. Now, tax should never drive anything. However,
But it does.
but it also provides credibility.
Yes.
There's a huge credibility piece from being a DGR. The second piece is, and we spoke about this very briefly, the branding and the messaging. That's very powerful in recruiting somebody. When I was at PwC, we were involved in the startup of the Great Barrier Reef Foundation.
Yep.
And that was basically done by PwC as a pro bono piece of work. Within 3 months, they developed such a brand around it that we actually had the chairman of CBA was the chairman of the board of that. The doors that opened was phenomenal. They never had a funding problem from that day onwards.
I mean, we ran last year, we ran a significant piece of research around why people join boards. And this is talking about private commercial boards. The number one reason, by this much margin, people join because they want to give back, because they want to add their services to other business owners, not for the prestige, it's not for the title, it wasn't for the money, it was actually just because they want to contribute.
I think where you're looking for property and so on, think a little bit laterally about the model as well. So for example, I was involved in a gift recipient that was providing permanent housing to the disabled.
Yep.
We couldn't get the funding to go and buy the properties,
Yep.
but we could get the funding to rent them. And so we actually went to a couple of builders and said, well, you build them, you own them, and then we'll pay you effectively a very good return on that asset for you to own it for a long period. So think laterally about
Yep.
your model and your outcome. Government is not averse to taking long-term leases on properties,
Yep.
rather than actually physically. They actually struggle with the concept of owning an asset. They have no problem with it being an expense and renting it.
That's why they're selling all the assets.
It's perverse, but it's fundamentally a cash flow play for them. And there's actually 2 media buyers in Brisbane who control the majority of media for property developers. Believe it or not. Yeah. There's a lot of people who provide the advertising,
Yep.
but they essentially go through 2 media buyers to buy the space. So sometimes it's knowing who's the right person to tap up in the supply chain to get the right introductions and the right...
The right connection.
Yeah. Your biggest challenge will be managing the demand incoming for people for space, and how do you manage the press and the messaging around that?
Yeah, we've got strategies around that as well.
Yeah. It's actually managing your downside risk is probably going to be a big part of your challenge.
Yeah.
How do you choose one over the other?
Yeah.
You want to go to one apartment available and go to people that want to get into it, huh?
And it's a problem for every not-for-profit. It's a problem for every not-for-profit. How do you choose who you do help?
Well, we've got some interactive software that we've self-funded, so we've got 6 teaching tools, but we'd like to expand that to about 100. And we lack the funding to be able to do that. And that links together with our other materials.
So that might be one where you have a look at whether you separate the content from the software.
Right.
So you're in math, for example. Could the tools be adapted to, so my daughter's on the autism spectrum and we're really struggling with her with reading. I've pretty much employed a teaching student full time, I feel like, to help her through reading. Right? Could the tools be adapted for that? Could it be done for science? Could it be done for a range of other subjects where you're not the subject matter expert? But there are a lot of models out there where you effectively wind up having 2 businesses, and the software engine part actually becomes the more valuable because you get a lot of content developers building their piece on top. And there's plenty of examples out there. And in terms of raising funding, there's quite often more funding for that software piece and the ability to scale that and have a whole lot of people using it as an industry standard, versus just a content delivery piece. Because the challenge with content delivery pieces is they don't appeal to everyone. You'll find you'll get people who'll subscribe to it forever and it'll provide a great annuity, but it's hard to get global widespread acceptance in any field.
And in terms of equity crowdfunding, mean, right now, quite frankly, I think it's anybody's guess when it's going to happen. I mean, unless one of you guys have newer views than I have, but it's like there does not appear to be anything on the horizon.
All I can tell you, ASIC have got those high net worth investor rules and limits around number of investors and so on in place because of, they were all put in place because of things that have happened in the past. Where when I first started as an accountant, I started in forensics and litigation support, and one of them, a group of guys who got together in Brisbane, started a friendly society under the old Friendly Societies Act, and basically took $30 million from elderly investors, and it was never seen again. The reason these rules were put in place was to basically make sure that investors were educated, they were well informed, and to basically stop a lot of these rules that were happening in the 80s and 90s, which is where corpus law was effectively born from. Unfortunately, there's a lot of people in power who remember that, and a lot of people who don't want to see a return to those sorts of things potentially happening. And that's where I think they're struggling with the balance between all the benefits. How do you legislate for the positives crowdfunding could provide, but provide protections without, to be honest, basically taking all the money that you would have raised into compliance activities.
But we're the most highly regulated, in terms of financial services regulation. There is no country on the planet that I'm aware of that has stricter regulations than we have here. And, sure, it gives great protection, but, has a massive downside. I think the broader answer that I've seen, and I've been close to a couple of crowdfunding campaigns in the last few months, is that the single biggest determinant of crowdfunding success above everything else is, are you amazing in marketing? If you're not amazing in marketing, and I don't mean just good, not just great, not just awesome, but amazing at marketing, it will not work.
And to be honest, that's my biggest problem with it.
Yeah.
There's no substance.
It's a sales piece.
Yeah.
And that's why I'm still on the fence with crowdfunding. I can see that's a good idea for simple businesses. Somebody comes up with some new amazing jeans that look great. Do you want to be part of it? Yes, it's a small amount of money, let's do it. Once you get into something just a little bit more sophisticated, I still don't think it's a good idea, because you need to know exactly what you're getting into. And when it's all about making it look amazing rather than providing you with the detail and the investors actually understanding those details, you do get people into a situation where they don't really understand.
How do you make sure the money was spent what it was raised for?
Exactly.
If you raise $500,000, sorry, the jeans venture failed. We made a pair, tested them in the market, nobody wanted to buy them.
Beehives.
I spent 10 grand, there's 490,000 which I'm going to do the Houdini with.
And what about the crowdfunding arena for the not-for-profits? It's got a...
Well, that's different because you're not taking an equity stake.
No, I know.
And again, if you're a DGR and you're using that crowdfunding to basically raise donations for an outcome, absolutely, that makes perfect sense. That part I get, but you're not taking an equity stake, you're not under the ASIC rules.
I know, totally.
Yeah. But that's where, as we were talking about, you get the right PR person who's putting the right message together, you marry that up with the crowdfunding opportunity, and you've got a whole new way to raise money. I've seen academics use it, for example, to get funded to go on courses.
Sure.
And they'll provide to anybody who gives them money, they'll actually provide them a full breakdown of what they learned on the course. And they've raised it within a day. So it can be used in some very, very clever ways. But I think the equity piece is just under our current framework, is a tough one. Because the other piece in Australia you've got that's very different anywhere else in the world is our press are always looking, tall poppy syndrome. They're always looking for the bad news story.
Yes.
I was the press representative for PwC in Brisbane for 5 years. Did over 150 Courier Mail articles, and every interview I had with the Fin Review, the Australian, and some others, they were always looking for the bad news story. And you'd take them a good news story of a business that was doing really well, or somebody who had a really innovative idea, and the first thing they'd do is look for the way to knock them off their perch, and it was terrible. And unfortunately, I think one of the things with crowdfunding is we'll only take one person doing the wrong thing, and they'll kill it for everybody.
A friend of mine who actually has a capital market background, you know, he put a project on crowdfunding at the end of last year over Christmas, and they didn't achieve the funding they were looking for, and it's a cure for something that, you know, a very, very significant part of the female part of the population suffers from, and you know, it's, you know, potentially debilitating when it sets in, but he couldn't raise the funds, and it's not because, you know, it's complete medical breakthrough. It ticks every single box on the logical front, but there was not this sort of connect emotionally, and there was a lack of, well, where's 100,000 people that's going to come in and swamp it? And if you don't get that initial huge surge of people that come in literally within the first couple of days, if you analyse a crowdfunding campaign, you have about 5 days. If you don't make it in those 5 days, you won't make it at all. And I spent a lot of time last year with two of the US crowdfunding companies, one of the Canadian ones and one of the Australian ones, and they all had exactly the same curve. Like literally, it's about 5 or 7 days, and it falls down almost to zero.
It opens up some very interesting governance questions too. Like having said on worked with some newly listed companies, potentially you're actually dealing with the same number of shareholders that are listed. The sheer cost and effort you have to go to report to them, to manage them, their rights, shareholders meetings, you've got to go and hire an auditorium. It opens up a whole Pandora's box from a governance point of view, and just from put the corporations law aside, just from how do you do it equitably.
And there's obviously sort of hybrid sort of solutions like ASOP, which is here in Queensland, which is sort of like a crowdfunding platform, but it isn't really. It operates on a separate, what do we call it, exemption.
Correct.
But that really truly actually operates as a crowdfunding kind of platform. We just don't call it that because it's been around for 20 years, so back then we didn't have the word.
But ASOP ticks all the compliance boxes.
Absolutely. They do.
But again, there's a cost to remaining as part of that. So quite often going down the private equity, when I say private equity, I don't mean PE firms, like one option, but talking to high net worth, talking to people who've got interest in that space, there's quite often cheaper and easier ways to get funding than going down that path. I worked with clients and I was an advisor to getting people down that path, and it was just one of many options.